So we're often asked, how do you handle market volatility? We've seen dips over time in the equity markets, but there are many markets out there. So the first question we must ask is, which market? Most of the time people are referring to the Dow or S&P 500. They hear that the market was up or down 1 or 2%, or during a bad time it was down due to a correction of up to 10%. Unfortunately, most of the time people's portfolio is not mimicking that type of an industry or market. We've developed a process and formula that we refer to as Tria. Tria is Latin for three. The first part is core. This is where you have exposure to the equity and bond markets. Typically, we'll use an ETF-based portfolio with hedging at times to counter the market volatility. The second is opportunistic. You can actually participate and take advantage of the market volatility as well. If you see oil prices become depressed, a broker might tell you to buy an oil stock like Exxon, where we might actually tell you to look at buying the mineral rights and the drilling opportunities through the partnership. Another one might be real estate. There are opportunities in multifamily housing, for instance. You could either invest in the stock of a developer or home builder, but if it's a public stock, it acts just like the normal market and doesn't insulate you at all from the volatility. You could also take a chunk of your money and buy an apartment complex on your own, but that doesn't really alleviate any of the risk and usually takes a large sum of money. Our clients can go into a partnership or LLC that will now help assist in managing the volatility of the market portfolio. Think of apartments. The first of the month comes around, nobody's checking the S&P to determine if they're going to pay their rent. The third area is risk protected. Typically, this is related to the insurance industry. By utilizing specific index-based life insurance and annuities, people can invest with the market and participate in the upside with principal protection on the downside. Overall, we help to get a clear picture of a client's needs, goals, income tax, net worth, risk tolerance, and this formula will tell us how much to invest in each. By doing this, a portfolio might only have 40 to 50% in core, and of that, maybe 50% in equities. This helps to mitigate the volatility and lessen the blow.